we get started this afternoon, I just wanted to welcome all of our guests and let you know that this presentation this afternoon is being recorded. The ideas, views, and forecasts that we are going to discuss this afternoon are subject to change without notice, may prove incorrect, and do not represent recommendation or offer of any particular security or investment. Telarray has no obligation to provide revised assessments in the event that circumstances change. There's no guarantee that the strategies described will achieve stated goals. Investing is a fundamentally uncertain process, and Telarray cannot predict the future or guarantee any specific investment results. This material represents Telarray's intellectual property and may not be published, reproduced, transmitted, or rebroadcast in any form without the express written permission of Telarray. My name is Chelsea Sloan, Director of People Experience here at Telarray, and I'd like to welcome you again to this afternoon's presentation on why to work with a financial advisor, in particular, why Telarray. Our presenter this afternoon is Jean Gard, Telarray's Chief Investment Officer. I will be taking questions through our chat box this afternoon, so please feel free to type those in if you have them during the presentation. If not, we will try to reserve some time at the end for a Q&A session. Please feel free to use those, and Jean will be more than happy to answer all of the questions that we have. Thank you again to everybody for being here with us. And Jean, I will go ahead and hand it over to you.
All right, Chelsea, thanks so much. Really appreciate the introduction. Today we're going to talk about why hire a financial advisor and why hire Telarray potentially. And the first thing I'd like to point out is we're not saying why hire an investment manager. Investment management is something important that we do here at the firm, but it's just one small part of the overall picture. A very important part, nevertheless, it is just one small part. I think when you think about people who are considering a financial advisor, there's kind of a continuum. On one end is the people who just are never going to hire anybody to help them with something like that. Those are the kind of people that do their own taxes, that do their own investment work, that do their own estate planning, sometimes at their peril, oftentimes, which we'll talk about later. But people like that just aren't going to work with somebody no matter what. On the other end of the spectrum are people who know that they don't have a lot of expertise in the area and are going to need some help, and they're pretty committed to the idea of having advisors. But I think there's a big gap in the middle of people who have some knowledge, have some skills, have some DIY experience doing this kind of stuff, and they are conflicted about whether or not they should continue doing it themselves or if they should hire somebody. So we're going to talk about today, that's one of the main purposes of this, is to sort of talk to that central audience of people who might be thinking about a financial advisor, maybe have never used one, maybe have somebody that they're not entirely happy with potentially, and just talk about in general some of the value that firms like Telarray can provide. So let me share my screen here. All right. So we will shoot for about an hour here. So, I think we'll be able to get through this material in a pretty reasonable time, and please ask questions along the way. And then at the end, we'll have a few minutes for questions as well. So, advancing the slides here. So this is an American Psychological Association study on the sources of stress. And I think it's really interesting to see that if you look at the most stressful thing pretty consistently over the last few years has been work. And that could be either the actual stress of work, but also the stress of potentially not having job security or losing your job. And you can see this goes through an interesting period because it includes the lockdowns. But also money is the second one pretty consistently, even through these varying timeframes, which again, ironically, it's only 3 consecutive years, but 2019, 2020, and 2021 were very different years. The economy is third. And then if you skip on down a little bit, there's still some things that are adjacent to the financial planning world, like personal health concerns, health problems affecting the family, housing costs, and job stability is down there at the bottom as a individual broken out thing. But you can see that finances are a big source of stress. So really what it comes down to, I think, for any financial advisor, at least what we believe in Telarray, there's a few questions that people want to know the answer to. The first of all is, am I going to be okay based on my income and my savings, my earnings and my spending and my practices? Are things going to work out for me to be on track to retire someday, or maybe even some specific time? Another question is, what can I do to prepare? And I think that's really where the most value is for a financial advisor. It's not just that we look at what you're doing and assess how successful you may or may not have the potential to be, but more importantly, to give you tips and advice and opportunities to potentially move your retirement date around or allow you to accomplish more in retirement and before retirement, for that matter, and things like that. And then the last thing, some people are optimizers. A lot of people are optimizers, and they say, it might be that they're on track to do what they want to do. They might have a good bit of margin of safety towards those goals, but they might say, I just really want to know if I'm really optimizing what I'm doing. I want to tweak my investment allocations. I want to look at, exercising, say, my stock options at the right time. I want to look at all these things and really just make sure the tax wise, in coordination. We don't do tax preparation or tax work ourselves, but we do coordinate with others, and we do have on the investment side some tax considerations we work on. So people just want to know that they're doing everything they can to optimize, which I think big picture is the kind of things that you definitely would value if you work with a financial advisor like Telarray. So just some brief historical review. The practice of whatever you want to call it, financial advisory or financial planning, has evolved a great deal over the years. So just this is kind of a hierarchy of what's happened in time. So you can see at the bottom, originally, and even still today in some circles, really the way that you got investment advice was you just had a stockbroker, for example, that would help you buy maybe 10 or 12 stocks and probably turn those stocks over pretty frequently since they were paid by commissions. And that's sort of what investing was. And that was probably true all the way up to the 40s, the 50s, and even in some cases today, that's what some stockbrokers, that's how they add value for their clients. And that was also true for insurance folks. Insurance has increasingly had more and more investment aspects to it. And while we don't believe in things like permanent insurance as a really great investing vehicle, typically, that was also another source of sort of financial advice that people got. And even from accountants and CPAs and things, that was somebody that people would turn to. Some things started changing in the 50s. Some research came out and additional information about how if you buy more stocks, such as in mutual funds or even index funds, that you can get most of the return or all the return potentially with a lot less risk and sometimes less fees and things. So that sort of evolved into a world where people were buying mutual funds and things like that to invest their money rather than individual stocks. But typically you still had either a stockbroker type person, or in some cases, a financial advisor, like a registered investment advisor, that would help you with that. But really, what it was all about was still selling you investments or picking investments for you. A firm like ours, they would probably tell you that they were investment managers and they would manage your money. And that's the primary value that we would offer. And you can see that on the second tier here. But really, I'd say probably in the last maybe 20 to 40 years, it's been identified that while the investment advice is very important, it's just one small subset of all the other things you can do. And like we talked about planning for the future, it's important to get good returns. I wouldn't say that we don't try to optimize returns, but our job these days as financial planners is not to swing for the fences and try to get the absolute highest returns possible and pick the right funds and the right stocks and the right sectors that are going to outperform and move you there. But rather, it's really a long haul marathon kind of approach where we put together a portfolio for you that should help you achieve your financial goals. But we also look at your spending. We look at all sorts of things that go into that. So you can see at the top there, financial planner is kind of the pinnacle, we believe, of sort of the evolution of financial advice. And it takes into account investments, but it's just one small part of it. Probably one of the biggest pieces of pushback that people have about working with a financial advisor or a financial planner is that all the information is out there. So why don't I just do it myself? Because obviously a firm like Telarray, or really any firm, obviously must charge some kind of a fee for their services. So if I can avoid paying that fee, I'll be much more financially successful than if I can just, I'll be more successful if I don't pay that fee. So, there's some books. I put some examples here. I don't think there's any reason to hide it. One, the J.L. Collins book, The Simple Path to Wealth, has become very prominent and talks about a very straightforward way to invest your money in management and manage it. The Motley Fool has been around since the 90s, and that's a big other source of information about investing for yourself. And you can see there's a few other links over there, or not links, but images of just some things that are out there that people use. But what I would point out is that most of these are investment focused, which again is important, but they really don't focus on the bigger picture, I think. And I think as an individual, it's very difficult to not only understand all this and all the considerations that go into investing, but also the broader questions of taxes, estate planning, Social Security, all those sorts of things. Anybody can learn it, certainly, but that's true of anything. I mean, you could learn how to change the engine on your car, or how to operate, perform surgery. I mean, you could go get training as a doctor, but the thing is, there's only so many hours in the day. So unless you're willing to commit to really fully grasp these topics, I think it's very difficult to do it yourself. And the fees that firms like ours charge, if you find the right kind of firm, and of course, we think we're the right kind of the firm to do that, the fees, I think, are well worth the experience you get, and the things that you get to access, and the collective experience. None of us know everything here at Telarray, for example, but we have a team of just a very diverse team of experts in different fields that we either employ here or have access to. So we may not have every single answer ourselves, but we probably have a lot more answers than one person who's doing this just on the side for their personal interests would have. So I think this Venn diagram really describes it. You probably heard people talk about cheap, fast, and good, or price, performance, and reliability. It's always when you take three things, you can have two of them, but not all three of them, because it's impossible to have all three of them. And I think that's really true with managing your money and your financial future. Your plan can be effective, it can be simple, and it can be do-it-yourself / cheap, but you can't have all three. So we think the value proposition is very strongly in favor of having an industry-leading, well-reviewed, well-assembled financial plan that's effective, and allowing professionals like us to take care of it for you, which helps you simplify and consolidate everything in one place, and kind of tie down all the loose ends and make sure you're not missing anything. And the one we would recommend you leave out is the do-it-yourself part, because again, it can be done, but it's very hard to catch all the different missing pieces there, and it's certainly not simple or straightforward in our opinion. So we're really going to break up the rest of the presentation into two parts. We are going to talk about investments because it's very important, but then we're also going to focus on the non-investment part, or the financial planning part, which of course we hear, even coming from the chief investment officer, we think probably the non-investing parts, or if anything, even more important than the investing related stuff. So I just put some examples here of some of the pitfalls that you can experience. I spend a lot of time talking to people. I spend a lot of time on message boards. I've had a lot of experience talking to prospects and clients here at Telarray and other firms, and learn some of the things they've done in the past. And just to very briefly go through it, there's some pitfalls here that I've illustrated. One is gold. I mean, I met a guy at a different firm I worked with that he had taken all of his money essentially from our firm, except for, I think he had about $600,000. I think he left something like $50,000 of it with us, and he sent the entire rest of it to one of these companies that sells you gold. And he was sort of contractually locked in, and he was taking all this physical delivery of gold, which wasn't even safe because he didn't have a place to store it. And it was really bad. I mean, the fees, the effective price he was paying was exorbitant. And gold is something that we actually did a sort of a study on this and looked back, not at gold, but at silver. We actually looked back to biblical times and what a denarius, a silver coin would buy. And I think we figured out it was had something like $8 worth of silver in it at today's prices. And you could buy an amount of bread that's really comparable with the amount of bread that $8 could buy today. So essentially the investment return on silver for the last 2,000 years is essentially zero. And the same thing is true for gold. It can tactically have ups and downs in the short term, but in the long term, that's probably not something that's going to help you secure your path to your financial future. So, gold, we do have that in a strategy we have here called T2 that sometimes it'll tactically pick up a little bit of gold. But as far as gold as a long-term holding for the future, I think some people, just like that guy, a lot of people's financial futures have been derailed by 100% or close to 100% investments in gold. The next one there is the S&P 500. SPY is an ETF that tracks that. And if you go back, actually, that book I showed you there on the left, The Simple Path to Wealth, recommends just buying one ETF or one mutual fund, either something like SPY or something like a Vanguard total stock market index. And you can do a lot worse than that. But the issue is, if you look at the last 50 years, the S&P 500 is not one of the best performing sort of sectors. And what the S&P really is it's large cap sort of growth tilted companies. And growth doesn't mean good necessarily. In fact, really value versus growth in the academic sense means cheap versus expensive. So, the S&P is really more or less large cap US, somewhat expensive companies for the most part. And it's not something that is expected, A, to outperform every year, or B, even frequently, and C, it should just be one part of a diversified portfolio, because there's times domestic large cap stocks do great, but there's times other sectors do much better. So we just don't believe in abandoning diversification for just a few large companies, as you would get in something like the S&P 500. We actually have an allocation to an S&P 500 index fund here at Telarray, but it's just, again, one small part of the overall picture. So I think people are really exposing themselves to a lot of risk. And granted, since that book was published in the few years before, US large cap stocks have done very well. But since then, some things have built up to the point that I would say, for example, if the dollar stops strengthening and starts weakening a little bit, or some other catalysts develop, there could be a multi-year period where US stocks potentially do not have meaningful outperformance. In fact, they can be very challenged compared to some of the other things we diversify into. So definitely, I'd be very suspicious of that approach. Probably one of the biggest things that scares me is people who just put their money in cash. Right now, inflation is 10%, and I know people, very intelligent people, who have really never invested. They've never felt comfortable with it, and they've potentially even earned a lot of money and been good savers, but they just haven't gotten that power of compounding because they've essentially put 100% of their money in cash, and they felt secure about that. But for example, this year, you've lost almost 10% of your purchasing power being in cash over the last year. And long term, it's very scary, I think, to be in that position. I mean, if you look at charts of what CPI has done for the last, CPI has greatly exceeded the returns on cash, inflation, but also even if you get high yield savings type yields, I think in the long run, if you compared that to what you could have gotten in almost any meaningfully long period of, say, 10 years or so or more, you'd be very disappointed with what you see. And that's something that actually I want to do a separate video on, is these people who it's like people drive all the way across town for 10 cents a gallon cheaper on gas. A lot of people, they have a large sum of money relative to them invested in high yield savings accounts, and they'll move it around to get 10 basis points or 20 basis points more elsewhere. But really, they shouldn't be focusing on that. They should be focusing on a way to get a meaningful real return after inflation that is not something you're probably going to achieve with cash. The last two things here, or the next two things, are there's some people that just really insist that real estate is the only hope for the secure financial future. And I know as soon as I hear the term passive income, that it's probably somebody who has been influenced by these real estate quote unquote gurus, or sometimes I think they can even be charlatans. In my experience, there's nothing passive about real estate income. You can hire a property manager. There's some things you can do, but it's a very intensive thing that has risks of damages that may not be covered in insurance, and market declines. And usually real estate really relies heavily on leverage, borrowing money to be successful. So in my opinion, it can be a part of your overall financial picture, but really there's something very special about US, worldwide capital markets and investments in stocks and bonds and things like that. So it's funny, people insist on the need for passive income, but really there's no more passive investment than just capital markets, than stock and bond markets, because you truly can, the joke is that, my ETF in my portfolio never called me up in the middle of the night because its plumbing is broken, or the building caught on fire, or it has some kind of a code violation that you have to deal with. Certainly you can have problems, but it's hard to diversify broadly in real estate without using a big fund that again ends up having layers of fees and things like that. So real estate can be part of your approach, but I'm very skeptical and I'm very concerned about people who make it something close to or approaching 100% of their approach. And the last thing I threw down there is some people look to I bonds. This is a type of savings bond that's inflation indexed, and right now it has a very high rate of return, but it's close to 10%, but that return is not something you can lock in because you don't know what you're going to get after the first 6 months. It's not something that is expected to stay high, and just for a lot of reasons, there's people who are piling into I bonds that really shouldn't be putting most or all of their money into them. So these are just some examples, but these are some pitfalls you can fall into as a individual investor, that they seem very logical and they seem very sensible, but they can be really devastating to your long-term performance, even if you never technically lose money in them. Because, again, you can put your money in cash and put it in a savings account. You'll never lose money on paper, but the opportunity cost is vast. So, real returns on the U.S. stock market for about the last 100 years have been something like 5% after inflation. And the returns on real estate have been something more like 0.5%. And again, if you use leverage, that helps. There's been big bursts of extremely strong performance in real estate in certain markets, but you never know what those markets are going to be. And, things tend to revert to the mean. So probably in the long term, if you held enough real estate in enough places, you'd probably get something more like that 0.5% over inflation return in the long run. So I think that's important. And one other thing I like to talk about is, for the I bond people, if you could have gone back 100 years and bought I bonds and indexed your investment to inflation exactly for the last 100 years, you would turn $1 into something like $15 or somewhere around there. I can't remember the exact numbers, but if you look at stock markets, and granted, stock indices might not have been investable entirely for the last 100 years, but stock markets have turned $1 into $10, $20, $30,000 if you look at those charts that are sort of ubiquitous online. So there's just a lot of big mistakes you can make. And I think one of the biggest values of an advisor is that we help you be diversified and avoid pitfalls, and it's sort of like the tortoise and the hare. You might be surprised to learn that an entirely appropriate investment portfolio for a typical investor might not achieve even 10% returns a year for the next foreseeable future. But with that said, a mid to high single digit nominal return is likely all many people will need to be very successful up to retirement and beyond retirement. So when we talk about diversification, one of the important things we think about is one of them is geography. We definitely don't invest only in the United States. The world's investable markets are something like 60% US and 40% non-US roughly. And our portfolios here at Telarray are similar to that. And we insist on it, even though the last 10 years or so have been very strong for the US market, but less strong in other developed non-US and emerging markets. But we've participated in the US allocations we have, but also we have this diversification. If something goes crazy in Congress, if something goes bad with the dollar, if something, some sort of natural disaster or attack takes place in the US, or even if just we get some good old fashioned reversion to the mean, there's many reasons why we're not going to abandon the US, but we very much value that international exposure we have for all sorts of potential outcomes. I think asset types, that's the best term I could put there. But what I really mean is we don't just invest in stocks, and we do have an allocation to bonds. Bonds have been unpopular, but this is one of their not so great years. But even in this year, we find that our bond portfolios, given that we've had a stock market challenge, our bond portfolios have actually outperformed. Or I should say, the more bonds in the portfolio in the allocation here at Telarray, the better return you've had in 2022 so far. And that just kind of shows that even for a bad year for bonds, they still provide some diversification and ballast against big downturns in the stock market. Asset classes I have there, I think that's very important as well. We'll talk about factors a little bit, but we have value approaches. We do have exposure to growth. The way our funds work, we really have exposure to almost, I can't say every company in the world, or even we do have broad exposure to almost to many types of countries throughout the world. But the difference is, rather than something like a Vanguard Total World Stock Market Index, which owns most companies probably in the world that are investable at the exact proportions to their size, we actually own probably a similar grouping of companies, but just our fund providers weight that based on expected returns. So things like international small cap value, emerging markets, domestic small cap growth type exposure. We have exposure to all that in our portfolio, which I think is an important part of diversification. And finally, we do use 3 primary fund providers here at Telarray, but and we also use one additional one for a special type of fund. But we think that's important as well, to have some diversification in case there's we feel pretty confident about our due diligence, but we want to have exposure to multiple fund providers in case there's an accounting scandal, or again, some sort of natural disaster or some unexpected thing that causes challenges for one. We don't want to have our eggs all in one basket. So we think that's important as well. And these are all things that we insist on as your advisor, but it's not something that individuals would always consider. And they might even be misled or encouraged to abandon some elements of diversification, much like the J.L. Collins book, which is actually a great book, but just we would disagree with the specific investment advice in that book. So we can go and move on here.
Gene, before we step forward to this slide, I have a question.
Sure.
The question reads, do you also diversify by buying in different sectors like technology or healthcare?
Oh, sure. So if you were a Telarray investor and you looked at your portfolio, you wouldn't actually find, like a technology fund or a healthcare fund or a consumer staples fund, because again, we don't really look at it that way. And the reason is based on the research and the fund providers we use. While different sectors in that sense do underperform and outperform at different times, we don't think there's really any specific. I mean, the great example is technology, in that people say, someone just told me a couple months ago, they said, well, we need to be overweight technology because it drives everything. Technology is everything and it's the future. And so that sector should outperform. And that may or may not be true in the short term, but in the long term, some technology companies will do great. Some will go out of business. Some will go sideways for many years. And there's really no predictive power that technology is going to be the sector that's going to give outsized returns in any given year, or even on average in all years going forward. So our fund providers, again, they probably every sector you can imagine is well represented within our portfolios, but you just don't see those names in the names of the funds because that's not how we think about it, and we don't divide up our exposure based on sector. So I hope that answers the question. And so I just wanted to briefly talk about this. Again, we talked before about how originally investing was kind of the idea of just your stockbroker buying some stocks for you and turning them over every once in a while to kick up some commissions. And what we believe is, from there, if you go forward, there's active mutual funds that have existed for a long time, or private equity, or other types of investments which are more actively managed, and sometimes they might do great. It's really hard to pick the right jockey, and the problem is the performance of jockeys comes and goes, so it's really hard to get that just right and pick somebody who can pick the right things for you. In fact, we don't think there's probably really much evidence that anybody can pick the right jockeys or horses in the long run to through an active approach. So we do believe in index investing, and I think you could do much worse than just buying index funds at low cost and calling it a day. But our approach, which again is less common among individual investors, but it's something that the advisory community and especially we believe strongly in, that there's certain adjustments you can make from weighting things just by the size of the companies, and that's what's called a factor-based approach, or smart beta, or things like that. So I think having that slightly nuanced approach in the long run, we do believe that in the long run that will cause our clients to be better off than a simple indexing approach. You could do a lot worse than indexing, but this factor-based approach that we subscribe to with our fund providers, we think is an important bit of value we provide to our clients. So, and the last thing I wanted to show here is, I think this really, on the investment side, I think this one slide shows the value of advisor and investment manager that you use more than any other slide I could show. And what you can see here is it shows all sorts of different investments for the last 20 years. And you can see some did better than others. It so happened that real estate did the best over this 10-year period, which probably wouldn't be true in the future, I would guess, but you never know when it would or wouldn't. But all these returns are very, very acceptable. You can see the S&P 500 returns 7.5% a year annualized. And of course, that includes some really great years and some really horrible years. But what's fascinating to me is here toward the bottom is this 2.9% annual return. And that's the return of an average investor. So the irony is that this average investor was invested in all these different sorts of things. I mean, you can see this is a 60% stock, 40% bond portfolio, developed market equity, high yield bonds, small cap stocks. They were invested in all these things that perform very well, but an average investor managed to have a very low return, even invested in higher returning things. And the reason for that is that if you time things just wrong, and when there's exuberance and excitement, you buy something after it's already run up, and then you wait for it to decline and then buy something else that's popular, you can actually buy high and sell low and have a much worse return than the average of all the different things you invested in during the period, which unfortunately is part of human nature. And I think that happens to a lot of investors, and it's a very real thing. So if anything else, I mean, people quibble over fees for firms like ours, and even for our firm, the highest tier is a 1% annual fee on your investments. But I mean, you could see it's well worth paying a 1% fee if you're saving. And this is just hypothetical. This is not representative of any particular client of ours or anything like that. But I mean, you could see if you have the potential just here alone, not even looking at any of the other value that we provide, I'd sure be happy to pay a 1% fee if I could return my improve my returns potentially by multiples of that. So I think that's very useful.
We have a question about the behavior of the average investor. The question is, how is the behavior of an average investor determined?
Oh, sure. Well, that's a good question. And again, I want to stress this is very hypothetical, and I'm not saying that if you work with an advisor or us that you'll get 5+% better than you get on your own. I'm not saying that at all. But what this is actually, I don't know if you can read it, but I'll read it to you here. It says, so this is just the disclaimers here. This is from JP Morgan Asset Management. And it says average asset allocation investor return is based on an analysis by Dalbar Incorporated, which utilizes the net of aggregate mutual fund sales, redemptions, and exchanges each month as a measure of investment behavior. So, or investor behavior. So all that means is it's not really based on a survey or any actual person, but they just look at the retail fund flows. And so just for example, if it's a emerging markets equity fund, if they see that there's a very small number of people in it when it has a 40% return one year, and then a bunch of people jump into it and it goes, just, I mean, this is just, I'm making it up, but if there's 10 times more investors and the fund grows by 10 times because of all the people coming in, and the next year the fund's down 10%, then the average investor didn't get 40% one year and down 10% the next year. They did something meaningfully worse than that because very few people were invested in the good year. So again, it's completely hypothetical, but it's just, and again, I have to learn more about their analysis, but I'm sure it's based on real data, and it just shows that, again, even if you're invested in the right kinds of things, if you have the wrong kind of timing, you're not going to be successful. And that's, I think our firm, and really any good firm like ours, is very consistent in their allocations. We might have some changes in fund providers or the funds themselves, but keeping a relatively consistent allocation and just rebalancing. Rebalancing is one of the few ways to buy low and sell high. So if you own two things, one goes up and one goes down, you're going to sell some of the one that went up to buy some of the one to get down to bring your percentages back in line. And that actually is an opportunity, if you do it consistently, to buy low and sell high in the long run, or sell high and buy low. So hope that helps. So we've already spent 37 minutes talking. We haven't even talked about anything but investments. I'm a little biased towards investments, but I want to talk about all the other stuff. And really, and the analogy I always use is football season just started. So, some people think the investment portfolio is sort of like the head coach or the quarterback of your team. And we really believe that, I mean, the analogy I use is that the investment portfolio is more like your strength and conditioning coach. It's really important and you can't be successful without it, but it's just one step. And really the quarterback and the head coach in this analogy are really the advisor and you, the client, who are working together to come up with a plan for you for the future, which is effective and resilient, and analyze that plan frequently and make sure it's working. And the investments are part of that, but it's just one part. So, and I wanted to start with this because really I don't have a good screenshot because it's proprietary, but the main thing we do for you, the main tool we have to see if you're on track, other than the way you invest, is through what we call our observatory process. And so what that is it's a very nuanced, very detailed, very precise way to look at, so the future is uncertain, certainly, but, and a lot of people just sort of wave their hands about what the future could look like, and they'll just use Monte Carlo simulations or, very rudimentary tax estimates and things like that. But I think what our firm does that's unique, and there's commercial software that does similar things to what we do, although we don't think it's as nuanced and really as precise and effective. But we take your current income, your current assets, all those sorts of things, your mortgage, your student loans, anything like that. And we use that information to look at what you're doing now and forecast that out into the future. And we also estimate your retirement date, market returns. We'll get to that in a minute, but we put all this information in there, and then we actually run simulations where we actually test how you would have done with your plan and your estimates and what we think inflation will do and your raises in the future. We'll put all that in there and then actually test it against historical periods in the market. So, for example, if you're a younger person, we might test 30-year periods, to get you, say, from age, usually we try to get the youngest spouse to age 90. So if you're both 60 years old, we would look at 30-year periods historically to run you out to age 90. And the way we actually do that is we look at different asset classes as you'd be invested and approximately as you'd rebalance, and we actually test that for those periods. So for example, we start in the late 30s. So, we test how you would have done if you'd had your retirement trajectory through, 1940 to 1970. Then we try 1941 to 1971 and 1942 to 1972. And we use every rolling 30-year period we could to see how you would have done. And if your plan has challenges, we would identify which periods those challenges came in. And we'd look to see how many failures you have in different historical periods. And I think that's a unique approach because, again, you can model this through other sorts of simulations. But if I told you we tested you against an equity return of 8.2% a year with a 2.8 standard deviation and ran 10,000 simulations and it failed, 4% of the time, that's not really that meaningful. But if I said we tested 20-year periods and you were good in all the periods except for 1938 to 1958, and then from 1999 to 2019 with a couple of recessions in there, for example, that's much more meaningful, and it would help you understand how resilient your plan may or may not be to potential problems. So this observatory process is really the most important thing. And what's really great about it is we can model everything up and give you a sense of how you might perform based on historical experience. But then we can make little changes. We can say, well, what if you bought a vacation house? Or what if one of the people in the simulation retired at age 50 rather than age 60? And run all kinds of simulations to actually test real possibilities and see if it has what appears to be a large impact or a small impact or no impact, and things like that. So it really helps answer that question of, am I going to be okay? And this is something, again, I don't think you can effectively DIY. I don't think you can do it yourself. There's some software out there, but it's really garbage in, garbage out. And unless you have the money for the big name financial planning software that's commercially available, which we don't think is as good as ours, but in particular, our approach with the observatory, it's very difficult to answer those questions other than by using various thumb rules like the 4% rule and things like that, which are great rules of thumb, but they just don't take into account all the nuance that's potentially out there and give you really quite as much of a picture of how your approach might work. So that's what the observatory is. So you can see here, this is all stuff that we do, and just one little part of this is investment management. So, just going around the horn here, I mean, looking at education as far as even for you, if you're thinking about going back to graduate school or your children, getting through elementary school all the way to high school and college and beyond is an important thing. Also, insurance. We don't sell insurance, and we don't believe in it generally as an investment vehicle, although there are certain cases where it could make sense. But we really have a truly unbiased ability to recommend or not recommend insurance. And again, through our observatory process, we can test, the loss of, say, one spouse's income due to retirement or, death or disability or something like that, and see really how much insurance, life insurance or other type of insurance it makes sense to have. So I think unbiased insurance advice is something that's hard to come by. And I think that's another great value of working with an advisor like us. We talked about the observatory. As far as tax goes, again, we are not tax advisors. We do have a lot of CPAs running around here, but we don't give formal tax advice, but obviously we work closely with tax firms, and on the investment side, we do tax loss harvesting and some optimization stuff like that. And I think for most people, there's some black and white things you can do to help improve your tax situation. But as your account gets larger and more complicated, that's when we really can provide some value with coordination and brainstorming and strategies, things like that can really make a difference and move the needle. We talked about large purchase decisions, but again, if you have a lot of money in the bank and invested and you have good income, you might think sure, I can buy a second house, or I can buy a boat, or I can, buy whatever it is you might think about buying. But what's hard to understand is how that decision actually affects your future. If you buy a boat, that might be great, but if it might mean 2 or 3 years of your life, it might mean that you need to work 2 or 3 years more. It's really hard to assess that without actually testing it in something like our observatory. So that's, again, something I think that a financial planner that knows what they're doing can really add some value on. And of course, the big one, retirement planning, that's something I think it's sort of exponential when you're in your 20s and your 30s. It's just such an abstract thing. But as people age, they really start getting interested in when they can stop full-time work. And a lot of times retirement doesn't just mean sitting on a beach or going on cruises. Retirement could even mean different types of jobs, or different kinds of employment, or volunteer work, or there's a wide spectrum of things. So again, through our process, we can help you specifically answer that question and specifically come up with a plan of when you might be able to step away from your full-time job, which is becomes important to everybody at some point. And the last one here is estate planning. Again, we're not attorneys. We do have a licensed attorney on staff, but we coordinate very closely with an estate planning attorney that we think we can work with others, but we think we really have a pretty streamlined process that, and that's probably one of the biggest pitfalls I've seen, is people who try to do it yourself kind of estate planning. I mean, there's just so many examples. I was just talking to somebody who they wanted to simplify things, so they got their parent to put them on the deed of their house so they could avoid probate, which avoiding probate is a good thing, probably. I don't want to give specific advice, but it's probably a good idea. But you need to do it the right way. You need to work with an estate attorney that actually understands the implications, because in this case, by doing it that way, they in their state, they didn't get the stepped up basis on death because they were already a joint owner, so they didn't actually inherit the house. So it actually created a huge tax problem for them. A problem in the sense they just had to pay a lot more taxes than they wanted to, and there was really no way to get around it. So that's just one example of some mostly good advice that somebody sort of picked up on, but then they took the wrong actions to implement that because they didn't work with somebody who could help them. So and another thing I hear about working with advisors is they say, well, it might help to get everything stable, and then but then I'm not going to have a lot of changes, so I just don't see the value in working with an advisor year in and year out. So this is just kind of a funny chart that I've seen. I've kind of gathered it from different places, but this is a real thing. I mean, all these things happen throughout your life. I mean, there's nothing that's really stable for more than maybe 6 months or a year or 2 years. There's constantly things changing. So we talked about the idea of having a financial advisor. So again, if you're going to work with us or another financial advisor, we do have some questions we think that's important to ask, and we'll just go through these briefly. So one term you want to look for is fiduciary. What that means is that so for example, Telarray is a fiduciary, so we're legally obligated to work in your best interest. And what that means is, obviously we charge fees and we run a business here, but just for example, if you worked with a stockbroker, they didn't have a fiduciary standard, well, they would be incentivized to charge you as high a price for the investment as they possibly could, whereas you could probably go get that somewhere cheaper. But for example, here we have an obligation for best execution and things like that. So we can't just it's like a zero, in the sense it's a zero-sum game where if we make more money, you make less money, then we really need to focus as a fiduciary on how to make you make more money, is sort of one way I could describe it. I would, again, if you think about your some elderly relative, and if I had somebody that couldn't work with Telarray or wasn't here, if they were just looking for somebody to hire, I would say, well, just make sure they operate under a fiduciary standard. What is the total cost to work with you? We actually have a slide about that in a minute, but if you don't fully understand how the potential advisor in the firm gets paid, then you need to understand that better, or probably just not work with that advisor. We talked about the investment approach, but again, I would be very careful to fully understand the investment approach that's being used and make sure that it's logical and sensible and of a reasonably low cost. it's very important to, again, the investment stuff isn't the most important part, but it's an absolutely critical element of working with an advisor, and it's important that you understand what you're getting into. Now, I like to say, are you really a financial planner? We talked about how from the stockbroker world, it evolved into a world where you'd work with a firm like ours, but they would just manage your investments, and you were on your own for the rest of the planning that you needed to do toward retirement. So finding somebody who's really a true financial planner that can help you with investments, but also with the broad range of things like we showed on the previous slide, is something that's important. And then what are the offerings? Just, what are you getting? Do they help you with investments? Do they help you with estate planning? Do they help you with tax planning? Do they help you? All those things, just make sure you understand what you're getting and not getting. And then I think the experience of a team really matters. Just as though I wouldn't recommend a person do this work themselves on their own behalf, I would be skeptical of a standalone sort of one-person shop advisor that does everything and just doesn't have that backup of different people with different experience and expertise. The rule of three, we'll talk about that in a second. So I wanted to look at fees. The way firms like Telarray get paid is just based on the assets under management that we manage for you. And there's upsides and downsides to that, but we really believe that's the best model. So at Telarray, you just pay one fee based on your assets under management, and that's all we get as a firm. We don't get money from fund providers. We don't get money from insurance companies. There's nothing else there. The one other fee that you will end up paying at a firm like ours is a fee to the mutual fund or ETF manager that is in your portfolio. So the funds that we use, they have higher costs than index funds, but they don't have anything like the actively managed funds you see out there. And we could talk about that more, but we think that our fund fees are very reasonable. But that is something, it's not something you have to write a check for, but it's something that just automatically comes out of your assets that you probably will never even see. So that's why it's sort of insidious. So again, I think it's important to have a firm like us to help you pick the right funds that have an appropriate and reasonable and not excessive fee. Some firms they'll charge you by the hour, or they'll offer packages where you pay a certain amount of money to get a financial plan put together, but then it's sort of an a la carte thing. And that's probably okay. That's not how we operate. And the reason we don't do it that way is because we don't want you to have to pick things off a menu and sort of nickel and dime you. We want to do everything we can to make you successful. So we think by charging just one asset-based fee and then sort of not having any segmentation in our services, that's the best way that we can work with our clients. So I'd be a little skeptical of that. Performance-based fees are less common, where hedge funds and things use that, where they get a percentage of how much you're up, and they don't necessarily get paid as much when you're down. And that sounds good, but we think that also could incentivize risky behavior by the fund managers. So performance-based fees are something we generally also don't believe in. And things like commissions, loads, and sales charges. If you ever buy A shares where there's like a 5% upfront load that you get charged, or it's hard to find stocks that at least with modern brokerages that charge commissions anymore, but some stockbrokers can. So insurance, it's more common. If you see anything like commissions, loads, or sales charges, then you should probably be very skeptical. And the last thing we have here is this is all from the insurance world. There's some investments that sound really great. They say you get most of the upside in the stock market, but your downside is capped at a certain level, which sounds great. But when you put money into that sort of investment, which is really an insurance product, very few of those 100 cents of each dollar, or much less of those 100 cents than you would expect, actually ends up invested on your behalf, because there's all these sorts of charges like this. So if you start seeing anything like that, the more complex the way the firm gets paid is, probably the more you should be skeptical, in our opinion. So just something to keep in mind. Each firm like ours has to have what's called an ADV filed with the SEC, and you can see ours is right here. The fee section, it's just a screenshot, but essentially our fee starts at 1% of your assets and then goes down depending on how much money you have invested with us. And again, 1% might sound like a lot, but we truly believe for the value we provide, again, just helping you stay the course in the investments and not jumping around, but also all that other stuff in the financial part. We feel that that fee is very reasonable and in line with industry standards. So you can always listen to what people say, but this Form ADV is something you can always go read, and it has a lot of information, which we definitely would recommend you read if you work with us or work with anybody else. We'd also take a look at credentials. Here at our firm, we have a number of certified financial planner awardees. We have CFA charter holders, which is an investment related certification. We have a licensed attorney. We have quite a few CPAs. So we have a lot of credentials here, which I think is important, but it's necessary, but not sufficient. So what I mean by that is just because somebody has their CFP, that's something that indicates they've done the work to learn a body of knowledge and apply it, but that doesn't mean they can do no wrong. So I think credentials like that can be important, but they're not the be all end all. We'd be skeptical of agenda-based offerings. So again, if here at a firm like ours, we can invest in anything, and certainly any publicly traded mutual funds or ETFs. And so the things that we invest in for our clients, it's truly because we think that's the best possible thing, and we put a lot of effort into it. We can't think of anything better to invest in. But if you work with somebody who, say, works for an insurance company, they might actually do some traditional investing, but still they're very much, it's only a question of if they're going to like their insurance company's offerings or love them. They don't really have the option to hate them. So just something to be skeptical of. Broker check and SEC lookups, will show a screenshot of that. But anybody, any firm and any person, you can look them up on these websites and see their disclosure history, and if there's any sort of black marks against them. And more importantly, if you don't see them in these databases at all, then that's a serious red flag that you should understand. Either they are scamming you, or else there's something you don't understand, or maybe they're not a firm quite like you think they are. So if you can't find your advisor, potential advisor, or the firm they work for, then that's something you need to figure out. We've already talked about the portfolio stuff. So this is a screenshot of, like I said, there's the Investment Advisor Public Disclosure website, which is from the SEC. And then Broker Check is from FINRA, which regulates broker dealers. But again, if you're going to work with somebody, you should find them in these databases. And if you can't find them, you should figure out why. That's really important. So we talked about the rule of three. And what that means to me is that, again, you probably don't want to work, in our opinion, with a solo practitioner. So I call it the rule of three because if there's anything that's important that's happening, you probably need three people to do it. One person to be on vacation that week, one person to have appendicitis or have a sick kid at home, and then a third person to actually do the work. So you can see all of our different departments. We generally have at least three people. Right now, we're down one person on our investment team, but we're looking at beefing that back up. And one of our advisors used to be on our investment team, so we have some backup there. People experience is there's two, but they're able to cover very effectively and also get support from other parts of the firm, but particularly with the people that move the money and the people that help document what's happening and reconcile everything. If you see any less than three people that are assigned for those kinds of tasks, I would be very skeptical. So in summary, this is just some things that we think that advisors like us can do. The big one is avoid mistakes. We talked about the things you can do when you're trying to simplify with estate planning and things like that, but there's some big mistakes you can make that can have big impacts on you. We think that you can turn rules of thumb, like we talked about the 4% rule, into actual customized actionable information specifically for you. That's something we think we can do that's difficult to achieve on your own. We don't have to read all these, but blind spots and hidden risks, simplification, managing fees and expenses. Again, we think a firm like ours, fees are reasonable, but we also help you manage the expenses of all your underlying investments. So that's something that's very important. Guiding you through market cycles. Again, probably the worst thing that can happen is for people to go to all cash or de-risk when the market's already down because you missed that recovery. So just like that slide with the average investor performance, we think this is one of the biggest value adds we provide. And that goes into persistence and patience too. And then finally, just the broad education we provide on how you should invest and how you shouldn't invest and how you should approach your financial life and what you can and can't control. That's something that it really helps to get sort of a second opinion, we think, by working with somebody like us. So again, this is the big three, and you can't have all three. And we highly recommend that you seek out effective advice, which we believe we have, and the simplification that professionals like us can provide to your financial advice. And you can probably leave this one off, is probably the approach we would take. So in summary, I'd say the big questions are, we can help you answer, firms like ours can help you answer, are you going to be okay? And if things are looking good, the next question is, how can I prepare to do what I want and retire on time or early or achieve other goals? And then the last one for the optimizers is, once everything's kind of in motion, they want to optimize on the edges and figure out if they're leaving anything on the table. And I think that's something that's very difficult to figure out if you're just trying to figure it out on your own. So we're right here at the hour. So that was kind of a whirlwind tour, but I hope that helped you understand some of the value that a firm, an investment advisory firm, can provide. And then specifically, we talked a little bit about what we do here at Telarray, which obviously we're biased. And again, we're captive to nobody. So if we thought there was a better way to do things, we would be doing it. Our founders and our management has a very open mind to investing in people, investing in certifications, investing in technology, all of the above. So we really do think what we have is very much an industry leading approach. And I think we have evidence of our growth over time and the satisfaction of our clients that we seem like we're on the right track. So we sure enjoy serving our clients, and hopefully can continue to grow both our clients' assets, but bring on new people that we can add that same value for. So I hope this was just a little bit of a survey of how we do that sort of thing, and hope it helped. So thank you.
Thanks so much, Jean. Ooh, I was still talking.
Oh, sorry, I was putting your spotlight on.
Okay.
Yeah.
Thank you so much, Jean, for all of our information this evening. And again, there was a website and an email address listed on that last slide. Please feel free to reach out to us anytime. We can provide information for you, or if you know of anyone that we can be of help to. And again, we appreciate you spending the afternoon with us. Thanks, Jean, and we will see you next time.
Thank you. I'll just put up that information one last time here. And thank you, Chelsea, and we'll see you at our next session. Thank you very much.